I really want to focus on the banks because I know you cover the banks, and just a few things. First of all, starting with the note that you guys released today, I see that you put out something on UBA, and very interesting headline there, rising from the valley. I think that's been the rhetoric we've heard from many analysts, but what are the key issues that make you very positive about UBA right now?
Okay, for UBA, a couple of things. We revised our forecast, and the target price is now 480 per share. It's an implied upside of 27% from current market price. So the key drivers of our forecast is really an improvement in names because they really cleaned out the books. So the AMCON bonds have gotten from that process, considering the implied returns on those bonds. And second thing is a lower impairment forecast for UBA. So those are the two key drivers of our forecast. So we're expecting a 21% ROE this year, and it's really a valuation play because despite how bad the numbers have been, if you look at the level of improvements that came through in Q1, and potentially even if you discount what they can do by end of the year, our forecasts are very conservative. Okay, we're thinking they'll do 37 billion PAT by end of this year. Okay, if you analyze Q1 numbers, the implied Q2 PAT should be 26. We're saying they'll do 37 by the end of the year. So really, there's still upside risk to our PAT forecast for this year. So we're comfortable what we're forecasting. Target price, 470 per share, 27% upside.
Right, let's drill down a little bit because obviously UB has been in the news quite a bit, more so because of the huge loss they declared in last year. And of course, they've rebounded quite strongly, and the share price also has rebounded. But I think one big issue that I think many analysts continue to point to with regards to UBA is the cost-to-income ratio. It's pretty high, even amongst the tier 1 banks. What are your thoughts on that, and to what extent is that critical in the bank getting that right and moving it forward going into 2012?
Yeah, correct. It's very key, and UBA management also acknowledges this. So previously, it used to be a story of the Africa business, but the Africa business is now beginning to deliver revenue growth, and it's coming through quite well at the top line level. But if you then look at the Nigeria business, they have a number of branches which are not profitable.
And that's the big thing, isn't it?
Yes,
because they have well over 600 branches.
Yes, exactly. So they've actually been looking at the branch structure and looking at where they can actually cut down those numbers. So they actually plan to cut down in excess of 50 branches. Thereabouts. So they are actually working aggressively on that. They did about 30 last year. They're looking to do some additional this year. So that will be very key to driving down that cost-to-income ratio. And our forecast for this year is mid-60s level, about 68%. I think they expect about 65 for 2012.
All right, let's touch Skye Bank. And of course, they hosted a conference call last week discussing the Q1 numbers. PAT was 3.5 billion for the first quarter, up 5% year on year. What are the key things, or should I say the key takeaways from that call for you? Clearly, they've done some things right. Deposits are up 11%, but cost-to-income ratio is still pretty high at 72.
The key thing with Skye Bank is they need to tackle their funding structure. I think that's the biggest thing they need to tackle, because they are funding their balance sheet growth really with costly term deposits. And it's one of the, should I say, amongst all the banks to cover, they have the most reliance on term deposits. About 47% of their deposit mix is term. So that's really what they need to tackle. They need to bring that lower. And from that level, you then start to see improvements in the cost-to-income ratio, because the cost growth that's coming through at Skye Bank is quite benign. It's 10% thereabouts or less. So it's not, the cost growth is really not a concern, but they need to drive those revenues up. And it's really from the funding income level, because that high interest expense, it really weighs down on whatever comes through on the interest income line. So that's really what they need to focus on this year.
But what's the way forward there? I mean, we're talking about UBA trying to cut branches. Do you think Skye Bank is a bank that probably needs to invest in branches to get those cheap deposits into the...
You see, the interesting thing is on the conference call, Skye Bank also mentioned that they're looking at the bridge banks. Okay, so we think potentially there could be some value in the bridge banks. We don't know because we haven't seen their numbers yet. Okay, so it's really probably just AMCON that knows what the value potentially is. But these banks, I think the biggest thing that's causing a number of banks to look at this bridge banks process again is AMCON. Okay, and the mere fact that there's much clarity on AMCON driving this process. This wasn't the case last year. If we're going to buy last year, we're going to be discussing with the managers of those banks. So it's really AMCON, that clarity around AMCON driving this process that is causing a bank like Skye to come to look at it once again. But it's really, we think the branches are necessary, okay, but you really just need to look for cheap deposits. But the interesting thing is everyone wants cheap deposits. In the big banks, they're talking about it, Access, FCMB, everybody wants cheap deposits. So we think the tier 2 banks, we think they have a challenging time, over the next couple of months.
I mean, you mentioned AMCON, and I'm sure we'll be talking about AMCON quite a bit most of this year. Thank you so much, Soji, for joining us. Adesoji Solanke is a banking analyst at Renaissance Capital.